Your bank does not want you broke. Broke people cannot pay for anything at all. But contrary to popular belief, corporate retail banks do not want you to be wealthy either. Wealthy people barely interact with retail banking. They use private bankers and brokerage accounts. The ideal customer for a retail bank is someone in the middle. They need you productive enough to generate a steady income, but precisely stretched enough to occasionally overdraft and continually rely on their fee-generating products. There is a 2023 Federal Reserve working paper that classifies households along a mathematical spectrum, moving from financially fragile to financially resilient. The economists didn't pick an arbitrary number. Economists identified $20,000 as the point where a household moves beyond the reach of a bank's primary fee extraction models. Struggling to build savings is the intended result of a highly optimized extraction machine. Banks run internal account profitability models, and they have specific terminology for customers below that $20,000 line. They classify them as high-engagement accounts. Translated from corporate language, these are the users they legally and algorithmically charge the most. Conversely, if you pay your credit card balance in full every month and generate zero interest revenue, the credit card industry has a classification for you too. Trade publications and internal documents call those customers deadbeats. Think of a retail bank as a private 19th century toll road operator who owns the only bridge over a river. They set whatever price they want because your alternative is swimming. The toll operator needs you almost okay, productive enough to earn the toll money, but stretched enough that you can never afford to build your own bridge. The entire consumer banking business model relies on keeping the vast majority of its account holders perpetually trapped on that exact toll road. The machine targets its users through 5 distinct layers of extraction. Layer 1 is overdraft fees. According to the Consumer Financial Protection Bureau, U.S. banks collected $7.7 billion in overdraft fees in 2022. But they didn't cast a wide net. Just 9% of account holders paid 79% of all those fees. The bank engineers the optimal moment for the toll using transaction ordering algorithms. When multiple transactions are pending, the bank can choose the processing sequence. By processing your largest transaction first, they push the account into the negative immediately, causing the maximum number of smaller pending items to each trigger a separate fee. Wells Fargo paid a $1.4 billion settlement over exactly this practice. They did it because the algorithm was mathematically more profitable than processing transactions in the simple chronological order they arrived. Layer 2 is credit card interest. Federal Reserve data shows the average household carrying credit card debt pays roughly $1,300 in annual interest. Without liquid savings, a high-interest credit card becomes the default emergency fund. A car repair or dentist bill hits, because you cannot zero the balance, it stays and compounds at 24%. These algorithmic traps trigger the moment a savings buffer vanishes, converting a financial emergency into predictable bank revenue. Layer 3 extracts money through account maintenance fees. Banks typically waive a $15 monthly fee if you maintain a minimum balance. The fee is algorithmically calibrated to hit your account exactly when you have an irregular paycheck or an unexpected bill. It triggers the moment you are most vulnerable. Layer 4 is the desperation premium on borrowing. A National Bureau of Economic Research paper found that lenders can detect a weak negotiating position. They routinely charge financially stressed borrowers a higher interest rate than stable borrowers with identical credit scores. On a $30,000 car loan over 60 months, that hidden premium costs approximately $1,600 in extra interest. That extra cost is an invisible, undisclosed tax priced into every offer you receive when the lender senses you cannot afford to walk away. Financial institutions do not view a lack of savings simply as a risk to avoid. They view it as a mathematical opportunity to drastically mark up the cost of their services. Layer 5 never appears on a bank statement, making it the most invisible and expensive layer of all, the cognitive tax. In 2013, a Harvard and Princeton study measured the direct biological impact of financial anxiety by administering identical logic tests under high and low financial stress conditions. The researchers found that chronic financial stress actively impairs cognitive function by the equivalent of 13 IQ points. For context, a full night without sleep impairs you by about 8 points. This chronic anxiety leads directly to impulsive purchases and susceptibility to bad deals. The companies exploiting financially stressed people did not cause the stress, but they priced their products knowing this specific cognitive bandwidth deficit exists. They know their targets are simply too exhausted to thoroughly comparison shop. $20,000 in liquid savings is the specific numerical point where that chronic, low-grade anxiety becomes manageable. For the median American household, the 13 IQ points return. Once you hit this number, the downstream mathematical effects cascade immediately. Your checking account float handles routine expenses. You stop using credit cards as a buffer, driving your credit utilization down, which causes your credit score to rapidly increase. Crossing that threshold triggers a cascade. Credit utilization drops, loan rates fall, and insurance premiums decrease because the system recognizes your new financial posture. All of those structural savings merge into hundreds in extra cash every month, without receiving a raise. Reaching $20,000 acts as a kill switch, stripping the financial industry of its pricing power over your daily life. Hitting this kill switch alters your leverage in every relationship you have with anyone who needs you to say yes. A toxic manager, a predatory landlord, an underpaying client. Behavioral economists have a term for this shift. They call it outside option value. It triggers the exact moment a person possesses a credible, mathematically sound exit strategy from a negotiation. Desperation is physically visible in a room. When you possess a real runway of 3 to 4 months of expenses, you speak differently. You hold the silence differently after making a demand. The other side senses you are not trapped. The true value of the threshold is the ability to confidently walk away. Non-desperation is the most lucrative asset you can acquire. To escape the algorithmic traps, you need to execute 3 steps. First, pull your statements from the last 12 months and calculate your personal extraction rate. Add up every overdraft fee, maintenance fee, and the extra loan premiums you paid. That number is the direct cost of your vulnerability. Second, open a high-yield savings account at an entirely separate institution from your daily checking account. Having a different app and a different login intentionally creates psychological friction against impulsive spending. A standard bank yield pays $40 on $20,000 over 1 year. A high-yield account pays $940. That gap is hundreds lost to inertia. That 3-day transfer delay between banking apps provides the cognitive pause required to prevent impulsive withdrawals and survive emergencies. The consumer banking system is a patient, highly optimized toll road. Your only goal is to build your own bridge. Cross the $20,000 threshold exactly once and never pay their toll again.